Now it's my pleasure to welcome the first conference keynote speaker, Craig Phillips, who is the former counselor of the Treasury Secretary Steve Mnuchin, and interviewer Maggie Jiang, the board director and former president of TCFA and SVP of Bank of China. Please welcome them to the stage.
Good morning, everyone. Welcome again to the 25th anniversary of TCF's annual conference. This is the quarter century, a very special one for all of us. TCFA, to me, is a non-government backed, not part of any specific company, and it's 100% run by volunteers. So I really would like to thank the team for bringing the conference in front of you, and thank you so much for coming in this early Sunday morning. Today, we are extremely honored to have Mr. Craig Phillips to be our conference keynote speaker. I won't read his entire bio, but I do want to highlight a few in Craig's very distinguished career. Some of them is going to tie to the topics that we're going to cover today. As we know, Mr. Phillips served as counselor to Secretary of U.S. Secretary, served as counselor to the Secretary at U.S. Treasury from January 2017 to January 2019. Under Secretary Mnuchin, he focused on financial institution and capital market policies, fiscal operations, government asset and liability management, and general economic policies. He supported Secretary Mnuchin in the development of policy for comprehensive housing reform and oversight of Treasury's investment in Fannie Mae and Freddie Mac. During his time in private sector, Mr. Phillips held various senior positions in BlackRock, Morgan Stanley, Credit Suisse. He's also a pioneer in the securitized product industry. Welcome, Mr. Phillips. Thank you so much.
Well, Maggie, I'm glad to be here, and thanks for all of you participating with TCFA, but also in helping connect China and the U.S. and your career. So thank you for taking the time and having me.
Great. Before we get started, shall we show some hands so that Mr. Phillips know who are among us in the mortgage in the audience? Raise your hand if you have a mortgage. Not that many, huh? Raise your hand if you know, if you heard of Fannie Mae and Freddie Mac. Great. And raise your hand if you know mortgage-backed securities. Very good. What about GSE conservatorship? Okay. And Libra by Facebook. Awesome. Thank you. So today we are going to focus on a few topics in Mr. Phillips' experience. Part of it would be the government policy. We're going to talk about economic outlook, cover blockchain, an area that Mr. Phillips has spent quite some time on. Of course, we have to talk about China, and then we're going to ask him for career advice. So we're in for a treat. Mr. Phillips, shall we start it? Okay. Can you describe your role, the role that you played at Treasury, and what motivated you taking a role with the government?
Sure. I acted as counselor to Secretary Mnuchin, and I'm proud to say I was his first hire. We met many years ago as he grew up in the business in the securitized product area as I had. I was a bit older than he is, so I'd been in the business for about 9 or 10 years when he joined first Solomon and then Goldman Sachs. So the first thing in your career, be nice to who you're sitting next to, because it might be the future finance minister or some other person, because these network events and connections are very valuable. I had always admired people on Wall Street, which was my field, that went into government and served and then came back to the industry, because I truly feel successful policy in finance has to be informed by practitioners. And this through my career had happened many times, watching Pete Peterson, who was one of the co-founders of Blackstone, Roger Altman, who was one of the early partners of Blackstone, Ken Wilson, who I worked with closely at BlackRock. And so I always really wanted to serve. It just never really worked out until later in my career. So when Secretary Mnuchin was nominated to be Secretary of Treasury, I'd really made a commitment of wanting to go to Washington and get involved. I reached out, and as I said, I was his first hire. So it takes really, I guess, an interest. It takes some luck. You have to have some connectivity with people in power. And then it's a commitment. You know, you leave your private sector job and home and move to Washington, but it was a tremendous experience for me.
That's great. So what was the biggest challenge or biggest change from switching from private sector to public sector?
Well, what's really interesting to me was it was much more similar than I would have thought. You know, if you think of the Treasury, it's an operating business that really helps run the government. We fund the government through issuing debt. We make about 85% of the payments for the government through our Bureau of Fiscal, which you can imagine how many payments, 85% of the payments are in the government. And while we work on policies, it's very practical in terms of markets, financial institution policy, responding to emergencies. Say, for instance, recovery in Puerto Rico occurred on my watch. So I really found that all that operating role was very similar to really the private sector in terms of making decisions, execution, quality control, and even things like cybersecurity. Now, it probably really matters who your boss is. Secretary Mnuchin was an incredibly practical, goal-oriented individual. So he and I were really on the same page. You know, you might have differences depending on someone's background and orientation. Now, there was a third that was policy or so, a third or so that was policy, and that involved sort of newer skills. But I'd always been deeply enmeshed in sort of how regulation impacted markets and financial institutions, and as Maggie mentioned, housing finance policy. So most of the things I worked on in policy, while there was a lot to learn, and certainly the details are incredibly important, I was really quite familiar with the regulatory environment and also the different agencies that oversee our financial system.
That's great. And Mr. Phillips, you started your career from mortgage-backed securities or the mortgage industry, and you oversaw Fannie and Freddie Mac. In 2008, we know that both agencies went into conservatorship due to huge losses, that they cannot cover adequate capital reserve. But fast forward, both companies make Treasury about 11 to 12% return. Can you use this as an example to share with us your perspective on the bailout and how the government functioned to manage financial crisis?
Well, sure. I mean, many of you indicated knowledge about mortgages. I mean, if you get a mortgage in the United States, it might be from a bank or a credit union or an independent mortgage banker, but 7 out of 10 of those mortgages are then sold to either Fannie Mae or Freddie Mac, or sort of sold through Ginnie Mae securities if they're an FHA or a VA loan, 7 out of 10. So while the borrower doesn't see the activities of Fannie and Freddie directly, it's really how institutions are able to fund your mortgage. Many people who get mortgages also prefer a 30-year fixed-rate mortgage, which is quite unique in this market compared to other countries. And that in particular is really important for the banks to be able to sell off those loans and not hold that risk on their balance sheet and try to manage the asset liability mismatch and other factors. So first of all, Fannie and Freddie are really important. They've been in conservatorship for over 11 years, and the administration is committed to ending the conservatorship. One of the reasons I went to government was to work on this, and while we haven't finished it, we did put out a paper recently from Treasury that sort of gave a roadmap, and that roadmap was ending the conservatorships and allowing Fannie and Freddie to raise private capital again and have adequate capital to protect the taxpayer, to limit their risk profile as they have been since the crisis, so this never happens again, of having the risk, and a lot of that was on their balance sheet in really non-core activities of buying private label mortgage-backed securities rather than what I'd call their guarantee book, the function of buying loans and guaranteeing mortgage-backed securities. And also introducing competition. You know, there's a lot of anger about Fannie and Freddie failing, and there's a feeling that they had sort of a duopoly that gave them unfair advantages. So one of the ideas is introducing other parties to compete with them. But as Maggie said, this has gone from a bad bailout to sort of a good private equity deal. The government put in $180 billion to stabilize them. The government has since received over $300 billion of dividends. So it's high time that we turn the page, and rather than continue to take that money out of the agencies, allow them to build capital, raise capital, and return to a sustainable state while things are good. Someday there'll be another housing setback and a disruption in value, and it's critical that the system is in a strong, permanent state when that happens.
That's great. You also helped Secretary Mnuchin establish a new agenda for the Financial Stability Oversight Council, which is a cross-agency body. What are some of the key priorities? And do you think post-financial crisis, are we more financially safe and sound than before?
Sure. I mean, the financial crisis is something that was a shock that none of us really expected. And you had that event in 2008. The last similar event was in 1929. So while it's, if you go through history, there are shocks such as this. They're very, very unusual. So FSOC was formed out of Dodd-Frank. It's called the Financial Stability Oversight Council, and it's something I was really pleased to help Secretary Mnuchin run. He's the chair of it. And what it does is it gathers all the key agencies from the Fed to the FDIC, the OCC, the SEC, the CFTC, and others. And it's a way of sort of looking at systemic risk. But we really shifted gears to really have it be where we gathered to talk about current events. We might talk about crypto later. We had a special task force on cryptocurrency. We focused on emerging issues with leveraged loans and CLOs, among many other factors. So rather than trying to predict the crisis, we thought that just using the body and the convening authority to talk about common issues is important, because in the US we have a very fragmented regulatory system. Unless you actually talk about issues together, you really don't understand how to manage risk. We did take the view that the government is not in a strong position to predict the next company that would fail. So there had been some designation of SIFIs, or systemically important financial institutions. During our watch, we actually de-designated all of those companies. So AIG and Prudential Insurance were de-designated. Metropolitan Life had been designated, and a court had actually reversed their designation, saying it was not following the law when it was designated. So it doesn't mean there isn't risk among big institutions, but really the key is regulators looking at those risks, because it's not the one company that's going to cause the crisis. Any company might be the biggest in a certain product or service, but those services are part of a market. So our view is it's important to rigorously regulate and sort of escalate concerns from FSOC about a market or a product, rather than spending all the time designating an individual company. So there is soon going to be new guidance on this that will memorialize that, of sort of activities and regulatory action first and designation as a last resort. But honestly, it was a real thrill to work with the regulators and see how smart and dedicated they were at really trying to monitor the markets and the risk factors of those markets.
Well, thank you so much for the work in the 2 years that you were at Treasury. Most of us are in the industry, and we feel the regulation and scale back a little bit on the regulation, which give market the ability to do its best. Do you think, are we on the verge of recession or even a financial crisis? Why or why not? And the last crisis was caused by the housing industry. What sector is the next weakest link?
Well, look, I mean, the crisis did hit the financial markets at a time where there was a real lack of discipline. So first of all, I'm a big believer in common sense and discipline. So the biggest protection against a crisis isn't regulators regulating, but the market being disciplined and sort of managing credit parameters and flows in a disciplined basis. Many of you are associated with financial institutions, and obviously all of you are associated with finance. That discipline of sort of when to be less aggressive and think about your risk profile is key. Really, banks and the banking system have a whole new regime now of capital, liquidity. They have a regime to resolve themselves, resolution planning, or living wills. There's much better coordination on systemic risks across all the central banks and banking regulators, including between China and the United States. And in fact, large banks now that operate globally not only have their responsibility to their home regulator, but also in cooperation with resolution schemes around the world. And while that might be hard for someone like Maggie's bank, the Bank of China, to operate in 57 or so countries, it's critical to really have that cooperation, to really have a continuously operating market. So I feel really great about the controls that are out there now, and they're quite different than the crisis. The economic cycle's long here in the United States. You're seeing some rotation in Europe. But here there's really, to me, no signs of excess, and certainly excess that can be handled. So I'm not really particularly worried about something other than a slowdown. I certainly don't see anything like a financial crisis or really a deep panic at all in the cards.
That's great. We took care of the too big to fail in the financial system. What about the big techs? Are they too big to be regulated, too big to be contained? What are your views on the big techs?
Well, first of all, technology shouldn't be regulated. So the notion that we should regulate technology is just a bridge too far. We use technology in all aspects of our life and every company. So while there might be protections in privacy, cyber risk, the evolution of technology is creating this incredible economic expansion, and maybe one reason why it will continue. Now, everyone's not a winner in that because, man is replaced and women are replaced with machines. So there is an issue with things like artificial intelligence and other factors, machine learning, and what it's going to do for jobs. I think that's going to be the biggest tension. To me, companies like Amazon and Google and Facebook, Apple here in the United States, to just name a few, are under scrutiny for a couple things. One is monopoly and anti-competitive behavior. They've gotten so big, do they control pricing? And that's under review. And there's a real tension around using consumer data for advertising and other features, which is one of the reasons the world's changed so much and why it works. But the ethics and control of that, have come under questions, even to areas like influencing elections and other false advertising and other events. So I think the big tech companies have a cycle to work through. I think they're under scrutiny in Washington and most capitals. And even issues like taxation in Europe is a challenge. So I think it'll be really interesting to watch, but it's important we don't kill off innovation with sort of a resentment of either success of our companies around the world, including many companies in China, but also all the citizens are embracing these changes, so they wouldn't be so successful if the people didn't want these things. So I think it's very important for government to really look at the balance between what people want from technology and how the companies behave and really continue this growth, because I truly believe it's at the heart of the very long economic expansion that we've experienced around the world.
Great, great. And in terms of the technology, one of the latest trend and invention in the recent years is cryptocurrency and blockchain. You help study this cryptocurrency market issues while you at Treasury, and you also put out a fintech report. What are some of the key messages?
Well, sure. In terms of cryptocurrency, there are issues that the government needs to address in terms of market structure and protecting investors. So we did convene a task force to talk about it. But really, the reason we're talking about crypto is that it relates to blockchain. And personally, I'm a very large believer that blockchain will play a meaningful role in not only financial services, but many walks of life. So President Xi has announced the intent of having a central bank digital asset, which is, I think, extremely interesting and innovative. And he's articulated sort of the importance of that to economic and social development, and also how it can really reform finance within China and the movement of money in what's a large, fragmented, and arguably a country that's challenged to have everyone banked appropriately. So, I would encourage the Federal Reserve to also consider this. But absent that, there's also many, many companies that are involved in developing blockchain technology. I recently joined the board of a company called Ripple that has a global payment system. There's initiatives in security settlement and clearing. Mike Cagney, who is the founder of SoFi, has moved to start a company called Figure that really uses blockchain in the processing of mortgages. And there's all sorts of applications, not only in payments, but key areas like healthcare and other services. So I think the challenge is sort of what's good and bad about crypto. And as it unfolded, there was a lot of excess of coins launched through ICOs with schemes that were dubious at best. So I think what the regulators are grappling with is how to encourage the innovation and not overly regulate blockchain, but really protect investors in their investment in cryptocurrency. So sovereign efforts like China to have a sovereign currency are one way to do that. But I really think the private sector will play the largest role, and working out that regulatory regime is important. It really is kind of separate from big tech and separate from the banking system. My one wish is that the banking regulators keep working on ways of integrating the two. You know, some people like cryptocurrency thinks it's going to replace the world and there'll be no financial institutions. I think that's silly. I think financial institutions will still be important intermediaries, but the regulators have to help clarify, can they, handle cryptocurrency for customers? How do you handle custody and client reporting? How does taxation work? Can you run trading desks in it? So I predict that success in crypto will be aligned with the banking regulators around the world getting more comfortable with the established financial institutions, engaging with their clients in crypto transactions.
So do you see crypto or blockchain moving towards decentralized or centralized, as some of the government are trying to get into? Like which direction, or it's combination of both? The nature of decentralization fundamental for the blockchain technology versus central bank are incorporating the technology to improve their services.
Well, the key is use cases for blockchain. So you can have blockchains between known parties where it's like a network where everyone in it is known and admitted, and so they're all trusted. And you can have decentralized systems where anonymous people are mining or other factors to create the blockchain, but they're not directly associated with the activity, and there's not a membership, if you will. I think both models will play a role in the future.
Great, great. Now that we covered some of the topic, we have to talk about China, as this is a Chinese finance conference. Mr. Phillips, 70% of the US GDP comes from consumption. And do you think this is fundamentally the cause for the trade deficit? What do you think of the current status of the global tension around trade, and some of the policy you think that can help to solve the trade tension?
Well, sure. First of all, I guess personally I would say to everyone here, since you're operating as part probably of a Chinese company, or have come here from China at some point in your career to study or to work, either permanently or long term, perhaps you were raised here in the US, that first of all, I believe everything's going to be fine. You probably feel a lot of tension around this in terms of the policy, the dispute. I guess my number one point is that the tone set on this has been much too mean-spirited, and we really need to look at our differences as countries between the US and China, and we have significant differences in our political systems and our economic system, but at the end of the day, we have a tremendous amount in common. So I'm hopeful that there not only will be a resolution that's viable for both countries politically, but also recognize the tremendous strengths of the economies. To your question is, the trade deficit is just a reflection of consumer buying behavior here in the United States and the structure of our economy. And it's become more practical for goods and services to be produced elsewhere. And the supply chain is much more complicated than the relationship between our countries. So I personally am more in favor of maybe we need to reboot it, but the multilateral negotiations present at the WTO are much more valuable than sort of the individual bilateral between our countries, for the simple reason that if you look at a BMW, and you think of that as being a German car, well, there'll be parts manufactured all around the world for that car, and that car might be manufactured in South Carolina. So when you start to pinpoint sort of any one axis of trade as being an issue, you're really missing the point about how the global supply chain works. To me, they call it diplomacy for a reason, and hopefully what will settle in is a calmer tone. And I understand negotiating tactics, but a calmer tone really on both sides to really work to the interests of our people. Really, leaders around the world are kind of grappling with a lot of the same issues, aging of their population, rising costs of healthcare, concerns about immigration and, threats of terrorism and different factors that represent that immigration represents to other people, and really fulfilling our youth. So what we have with this aging economy is people that work for longer, and that's actually kind of squeezing out with high-paid jobs for our youth. I think technology for people that aren't trained in technology is also making it harder to get jobs that are well-paying. So I think our leaders have a lot more in common than would meet the eye, and while our systems are different, really a lot of the challenges are very similar for leaders around the world, and I hope that will start to take over.
I do echo your point about comprehensive view of this relationship. There's a recent news about potential U.S. limiting the portfolio outflow to China, and that may potentially limit the Chinese companies to get listed in global exchanges. And would that, in a way, escalate the U.S.-China trade tension into a full-blown capital war?
Well, if Secretary Mnuchin was here, I would tell him that's a terrible idea. Now, having said that, it's easier to say that because he's actually not sitting here. Personally, I think it's a rumor that hopefully is unfounded, that would be used as a tool. You know, to be more specific, what Maggie's referring to is sort of, you have a tension in trade, which is sort of goods and services. Should we somehow put up barriers to capital flows? And by, create that as a punishment, if you will, for issues relating with trade. You know, I'm a free market person and truly believe that capital needs to flow freely around the world. And I would really embrace the ongoing change in China. A lot of what you're talking about today is how to open up the financial system more on a symmetrical basis where, you know, Chinese companies are able to sort of move into the United States and many other countries. I think it would be a strength to allow non-Chinese companies also to enter China, something that in financial services has, you know, been established as a goal for some period of time. But if you limit the movement of capital, you're really just cutting off your nose to spite your face, because that capital, first of all, is mostly private capital, and people should be able to decide where to invest it. So it's needlessly punishing capital in terms of limiting opportunities. And I think there could be tremendous unintended consequences once you start that, where it would stop. China, for instance, is the single largest holder of US government debt. What if the US creates a policy on Chinese equity and China creates a policy on US debt? I mean, this could escalate into an enormous, unnecessary crisis. So I would be very hopeful that that would not be a policy that would come into play, and you've almost never seen that occur once we've had a modern global economy, and I don't think it's probably ever been successful. Now, sanctions are important. You know, we use sanctions of isolating bad actors, you know, around the world for terrorist activities and other things, which, you know, Secretary Mnuchin, the president, I greatly agree with that. You know, that economic power, among allies, you know, that people around the world largely participate in this, and it's not always complete agreement who is a bad actor and who is not a bad actor, but frequently there's a lot of consensus to do that, and that's been a very powerful tool. This does not remotely fall in that category, but it sort of feels like the same thing, and therefore is completely inappropriate.
Well, thank you so much for the insights from a policymaker point of view. We really appreciate that. Given that the audience, we are at different part of our career, we would like to seek your career advice. What advice would you have for young professionals in managing their career, and is finance still the way to go?
Well, sure. I mean, first of all, many of you are young. Not everyone's young, but many of you are at the beginning of your career. So first of all, the fact that you're investing in having a global experience, I think, is really valuable. I mentioned I always wanted to go into government service. One thing I also wanted to do was also live abroad outside the United States, which I never actually, even though I traveled extensively, I never actually relocated out of the United States. So first of all, the fact you're participating in that journey, while again it might be challenging at this juncture with what's going on, you'll learn so much from being part of that exercise. So that's the first thing, is thinking globally and participating in a global world, even though it might not feel well now. In terms of finance, I think the key thing that I see is just all skills are changing due to technology. So it used to be you'd go to undergrad, go work for 2 or 3 years, go back and get an MBA, and then somehow you'd be recruited by all these big companies. And that market's changed. I mean, the companies that are really starting to dominate are very young companies, you know, Stripe, Square, Coinbase, you name it. And the finance skills and the financial services are being delivered in a very different manner, sort of through digital marketing, through the internet. And even if you're a financial institution, like a bank, the chance that your customers interact with you in the branch has really fallen off because they really want to interact through their phone and have a digital experience. So I think the biggest challenge for finance, and this is true of every field, is how to have enough technological skills such that even if your company is not fully advanced in this way, you've got to believe that 5 or 10 or 15 years from now, how finance impacts the success of your enterprise will change. There'll be a lot more outsourcing of support services like accounting and tax, and an acceleration of the digital experience. So my advice to you is to, stay engaged globally. These type of networking events, as I mentioned, are very important, so I applaud you for that. But also stay attuned to the change in technologies and how that's going to impact finance and the prospects of your company, and that might impact what company you work for over time, because I think there will be winners and losers in that. For every company that booms because they have a technology advantage, there may well be companies that fall behind because they don't make the correct investment. That's not a Chinese or American thing. I just think that's just a fact globally, and you can see the rise of certain companies and the fall of different industries. So that'd be the one thing I'd be really mindful of. I think our schools don't do a good enough job integrating those. You're either over here in the engineering school doing computer science, or over here studying corporate finance. How do you sort of, once you're out of school, and most of you are out of school, how do you integrate those two things? I see it as a real challenge in human capital now.
Thank you. That's such a great advice. I would like to just open up to the audience for 1 to 2 questions. Do we have some questions out there?
You have a question, you can raise your hand. I can bring mic.
Yeah, raise your hand if you have a question. Oh, over there.
Mr. Phillips, thanks for coming to this conference. I work for MSCI, and I'm actually, with my colleague, co-head of the China Market Committee for the CIFIC. So during our interaction with the Chinese regulator, the most common question from the regulator is that U.S. has this GSE as a main kind of conduit for the mortgage financing versus any other country, mostly funded by the banks. So do you guys really want that system after this crisis last 10 years? And if you actually have to build something from scratch, what do you prefer? The banking funding system versus the GSE kind of capital market funding system?
Well, sure. As I said before, we're committed to a federal housing system. It's just how people who make mortgages are able to sell those mortgages. So the current policy is to support that. I had the pleasure of doing a trip through Asia, was at Treasury largely in support of our debt program, and went to Beijing. And there and elsewhere, I found an uncertainty about mortgage securities. Ginnie Maes are guaranteed by the full faith and credit of the United States, and investors understand that. And as Fannie and Freddie are in conservatorship, they are backed by a line from the Treasury, but they're really in conservatorship, which is a form of bankruptcy, and that line is not viewed as necessarily being predictable or permanent. So we really do favor a legislative solution where Fannie and Freddie have access to a full faith and credit guarantee, which would greatly clarify investors' confidence in them. I have no doubt that the Treasury will continue to support them because they've made a commitment to support them, but it would be memorialized in a way that would make it a lot easier for investors, particularly non-U.S. investors, to understand what they're buying. But I would have no concern that we won't still have the federal role might be a little too big. Rather than 7 out of 10 mortgages, maybe it ought to be 5 out of 10 or 4 out of 10. And that could be done by sort of the recovery of the private label security market and certain rules relating to consumers and banks. But I think you have a firm commitment in the policy to maintain healthy and Fannie, Freddie, in addition to Ginnie Mae. And hopefully we could have a law that passes that makes them full faith and credit, which I think to your question would make it sort of more predictable investment with better capital treatment like Ginnie Mae enjoys.
Great, thank you. Due to time constraint, we'll just have one last question, if there's one.
Hi, Craig. So what's your opinion about privatizing about the Fannie Mae and the Freddie Mae?
Well, what the fallacy is they're already private, so in other words, they failed and were put in conservatorship, but they continue to have shareholders. The common stock trades, there's junior preferred stock that trades. There is a board. The board's rights have been relegated to the conservator. So they really are already private. The real question is, there's really 3 options. One is just leave them in conservatorship forever, which is the path we're presently on. The other is to put them through receivership and make them part of the federal government. And I think most of us are concerned that the federal government running complex financial institutions, it's hard for me to see how that would be successful. And if you look at our other financial activities and student loans or veteran administration, health care, or the Postal Service, we don't think of these as high-performing organizations. I mean, they try, but I mean, so I can't see them being part of the government. So the third option is just allowing them to become fully reprivatized by raising capital and eventually changing the nature of the Treasury ownership through the senior preferred stock. So that's the path that's been selected, and we're going down that path, and I'm highly confident that they've already stopped the dividend sweep, so the companies are now retaining their earnings up to about $45 billion, while Secretary Mnuchin and Director Mark Calabria at the FHFA work out amendments to the PSPA, and they've promised to do that, really this quarter. They're hiring financial advisors as we speak. So a lot's in motion to really finish the privatization, but they already are private. They're just under conservatorship, and we need to end the conservatorship.
Great. Well, thank you so much. Unfortunately, this is the amount of time that we have. Let's put our hands together and thank Mr. Craig Phillips for his time and insights with us.
Thank you.